All right, let's talk about a strategy that is all about petting cool-headed logic against pure emotion. We're going to dive into the world of contrarian investing, which is really just a fancy way of saying a strategy built on profiting from, well, the madness of crowds. But let's start with a question that I'm guessing feels a little painfully familiar to a lot of us. Why is it that despite knowing better, we so often get swept up in the market's hype? We end up buying at the absolute peak of excitement only to turn around and sell in a total panic. It's got to be the single most common and most expensive mistake in all of investing. Well, the answer to that question, and really the entire reason contrarian investing even exists, it all comes down to a super powerful psychological bias that affects pretty much all of us, the herd mentality. So, what is this herd mentality bias? It's basically our natural tendency to just throw our own research out the window and do what everyone else is doing. We see a crowd rushing towards some hot new stock, and our gut instinct is to jump in, assuming they must know something we don't. The dot-com bubble is the perfect example of this. You had millions of people just caught up in this wave of euphoria, piling into tech stocks at prices that made 0 cents, only to get completely wiped out when the herd, as it always does, suddenly changed direction. Okay, now this is where it gets really interesting, because it's not just one thing. This herd behavior is driven by two different forces. On one side, you have information cascades. That's what most of us do. We see other people buying something and we figure, hey, they must have better info than me, so we follow them. But then there's this other, more professional version, reputational herding. This is huge for fund managers. They don't follow the crowd because they think the crowd is right. They do it because it's safer for their careers. Think about it. It's better to be wrong with everyone else than to be the only one who's wrong. And that behavior, it actually makes bubbles last longer and crashes even more brutal. So, what's the actual measurable cost of all this groupthink? Well, researchers at the New York Fed actually put a number on it. They found that because of all this flawed decision-making, an asset's price is, on average, 4% further away from its true fundamental value than it should be. And that 4% gap, that is the opportunity. That's the space where a contrarian investor lives and breathes. Which, of course, brings us to the solution. If the big problem is following the crowd straight into these costly mistakes, then the solution has to be a disciplined, thoughtful strategy of investing directly against it. So, what is contrarian investing really? It's all about exploiting that 4% gap we just talked about. This is so important. It is not about just being different for the sake of being different. Nope. It's a rational, calculated strategy to buy assets when the market is just drowning in irrational fear, and to sell them when it's totally blinded by irrational greed. It's basically a hunt for value in the places the crowd is too emotional to even look. And really, when you boil it all down, that's what it is. At the end of the day, being a contrarian is just being a value investor. It's about putting in the hard work to figure out what a company or an asset is actually worth, and then having the guts to buy it when the market is offering it up at a massive discount. But here's the catch, and it's a big one. The hardest part of being a contrarian isn't the spreadsheets or the financial analysis. The biggest challenge is the psychological battle you have to fight inside your own head. This is absolutely wild. Neuroscience has actually shown that when you decide to stand apart from a group, when you go against the consensus, your brain can light up in the very same areas that process physical pain. So when you hear someone say it feels painful to buy a stock that everyone else is dumping, that's not just a metaphor. It literally hurts. Your brain is hardwired to find safety in the herd. And that's exactly why so few people can ever successfully go against it. So to overcome that pain, a contrarian really has to build up 3 psychological pillars. First, just pure courage, the fortitude to take a position that everyone else thinks is crazy. Second, you need incredible patience, because your idea might take years, literally years, to play out. And finally, resilience. You have to be able to stomach watching your investment go down even further while everyone tells you you're an idiot, all without losing faith in your own research. So how do you even know when the crowd has gone too far? Well, one popular tool is this, the AAII Investor Sentiment Survey. Contrarians watch this thing like a hawk. When that bearish number, the percentage of investors who are pessimistic, spikes to historical highs, that's a powerful signal. It doesn't mean the market has hit rock bottom, but it's a huge clue that fear is peaking and that the point of maximum opportunity might be just around the corner. Okay, Enough theory, let's see how this actually works in the real world. Because this isn't just an idea. Some of the biggest fortunes in history were made by people who mastered this painful art of defying the herd. First up, the absolute legend, Sir John Templeton. His entire philosophy, his whole career, can basically be summed up in this one quote. He made his fortune by running toward the fire when everyone else was sprinting away. And his most famous trade proves it. Just think about this. It's 1939. The world is on the brink of World War II, and markets are gripped by absolute terror. What does he do? He borrows money and buys $100 worth of every single stock on the U.S. exchanges that was trading for less than $1. I mean, many of these companies were practically bankrupt, but his thinking was that a war economy would eventually lift all boats, and boy, was he right. That single bet paid off spectacularly and launched his incredible career. Next, let's jump to a more modern example you've probably heard of, Michael Burry. He became famous for doing what seemed completely insane at the time, betting against the U.S. housing market right before the 2008 crash. Now, Burry's genius wasn't just in seeing the crash coming. It was in his resilience. He used these complex things called credit default swaps to place his bet. But for years, the housing bubble just kept getting bigger. He was bleeding money on premiums every month. His investors were trying to pull out. The pressure was unbelievable. He endured that physical pain of being contrary for years before he was finally and spectacularly proven right. And of course, you can't have this conversation without talking about Warren Buffett. His most famous quote is literally the definition of contrarian investing. And he doesn't just say it. He puts his money where his mouth is, at a massive scale. Take October 2008. The financial world is collapsing. Panic is everywhere. What does Buffett do? He becomes the lender of last resort. He puts $5 billion into Goldman Sachs. But he doesn't just buy their stock like a normal person. No, he used the panic to negotiate an incredible deal for himself, a guaranteed 10% dividend plus warrants to buy tons of their stock on the cheap later on. It was a masterclass in using other people's fear to get a deal with very little downside and absolutely massive upside. Okay, but before you run off and start betting against the world, we have to talk about the dangers. Because being a contrarian, frankly, can be incredibly risky if you don't approach it the right way. This right here is the single most important question you have to answer before you make any contrarian investment. Because you know what? Sometimes the crowd isn't wrong. Sometimes the stock is unpopular because the company is actually a sinking ship. And that leads us to the thing that every contrarian dreads, the value trap. This is when you buy a stock that looks cheap on paper, but it just keeps getting cheaper and cheaper and cheaper because the underlying business is fundamentally broken. The only way to avoid this is through deep, rigorous analysis. You can't just buy something because it's down. You have to buy it because you've done the homework and you're confident its true worth is way, way higher than its current price. So what's the big takeaway here? Successful contrarian investing really just boils down to discipline. It's about always prioritizing the financial health of the business over a low stock price. It's about thinking in years, not weeks or months. It's about using patience as your ultimate weapon. And maybe most importantly, it's about diversifying. Because even the best contrarians on earth are going to be wrong sometimes, and you have to make sure that no single bad bet can blow up your whole portfolio. So I'll leave you with this final thought. We know for a fact that the herd is almost always wrong at the points of maximum fear and maximum greed. The real question then is, as you look at the market today, where do you see that extreme emotion? Where might the crowd be making a huge mistake that a disciplined contrarian could turn into a massive opportunity?